All right, guys, welcome back to Everything Money. I'm really such a bad host compared to Seth.
You're doing all right.
Seth is not allowed to be ever like on vacation ever again.
Seth is very good at what he does.
Yeah. He comes in, he's like, hey, folks, thanks for coming to the show.
How are you today?
Yeah.
I'm looking right in the camera at you.
All right, so we're doing Garmin today. We're looking at Garmin today. There's a funny story. Tim, you want to tell the story? Should I actually tell the story since I'm on camera?
Yeah, you tell it.
So a few years ago, Tim and I have a very mutual bond about being on time. My ex-girlfriend, she wasn't the best at being on time. Tim's wife isn't the best at being on time, but we love her. Tim's wife is the reason why Tim actually works with me right now. But years ago, his wife was coming to a meeting with me. She was late to the meeting. She gets to the meeting and goes, oh, I got lost. So, of course, I went on Amazon immediately, bought her a Garmin GPS and said, you'll never be lost again. Shipped to their house. And Tim says she still uses the Garmin, even though we have GPS on our phone. So a lot of people would think to themselves, well, Garmin, like I have it on my phone. They still provide a lot of the data and a lot of the software for people, for companies that do this, and they're very big in the boating world.
Yeah, to phones and cars and boating.
And watches.
And watches, yes.
So I thought at first, when I first saw Garmin pop up on my value list like last year, I was like, what? Nobody, or 2 years ago, I'm like, who the hell cares about Garmin? And then it's like, oh, okay, they have a lot more than just...
Yeah, they've done a good job of incorporating themselves in other businesses.
Yep. So $29 billion market cap, we'll call it 30. PE of 27, that's an X, but look at this healthy margin. 24% at the bottom line, 60% gross margin.
That's great.
They have a dividend of $468 million, 1.6%. Now remember, for those of you who are new out there, which we have a lot of new viewers every day, your dividend isn't always secure. Companies will put their dividend up just to get you excited and to buy the stock so the stock goes up. So you have to compare the dividend to the free cash flow. Last year's free cash flow was $1 billion, so they definitely had plenty of money by a ratio of 2-to-1 to pay their dividend. High return on assets, 15.7%. So far, 1X on PE, but 1 check. Other things are looking pretty solid. Let's go to our revenue. 3.06 billion to 4.4, check mark. So for those of you who might have thought Garmin was dying, look at the last 10 years, 2.8 to 4.4. So it isn't a fast growth company, but that's okay. We don't need fast growth to make a good investment, right? We just need to be able to pay the right amount for the growth. Net income, pillar number 4, 668 million to 1 billion, a check mark there. They've doubled their profit in the last 10 years. Shares outstanding, guys, a silent killer. Let's see what they're doing. Oh, barely, but they are still issuing more shares.
That surprises me for a company like that.
Yeah, barely, but I mean, it's not terrible. It's not really making me cry, but it is. I am surprised too. But the good news is in the last 10 years, the shares are down.
That's
Paul,
good.
why do companies default to that, to issuing shares? So I know that growth stages, you've explained that. Some of the big companies, Tesla or whatever, is issuing shares because they're in a growth stage. What about Garmin, the 10 years? Why would they do it?
So if I'm a CEO who, if my stock is overpriced, would I rather issue debt and hurt my balance sheet and hurt my investors that way? Or if my stock is overpriced, I go, you know what? I'll just issue more shares at an overpriced value. You're basically buying something with overpriced shares, which essentially is like paying less for it. So I do understand when a stock is overpriced, why a company would do that. 27 times earnings is pretty high for a company like Garmin.
So is it healthier for the company to issue more shares?
The perception is because people don't ever look at the shares outstanding. They always look at the balance sheet if they even look at financial statements. So when you look at the balance sheet, would you rather show increasing debt or would you rather go affect something that nobody ever looks at?
Okay.
Of course.
Yep.
Okay. So next one, balance sheet. 3.6 billion in cash and cash equivalents versus 933 million in total current liabilities and 1.28 billion in total liabilities. Guys, that's incredible. They have literally $2.3 billion more than they need to pay off all the debts of their company. That means that you at home have a personal checking account with enough money to pay off your mortgage in full, your car payments in full, your student loans in full, your credit cards in full, everything. You'd have no debt whatsoever, just using the money in your cash in your bank account. That's incredible. So you have to deduct that $2 billion from the market cap, so it goes from 29 to 27 billion, not a big difference. Now for the big mamma jamma, the cash flow statement. Their cash flow went from 588 to 1 billion. Check mark there with an average of 730. 730 times 20 is $14.6 billion. That is an X because they're currently at 27 or 29 billion overall.
About 20.
So the company is currently overpriced. Let's go check out the 8 pillars tab because I think you're going to like what you see here. These are the big ones. It's like a lot of companies.
Yeah.
Great numbers here, bad valuation.
Yep.
So after Mo goes through the charts, we're going to put this in the stock analyzer tool, and we put it in the stock analyzer tool, it'll tell you based on your assumptions of growth, things like that, what you should pay for the stock today. I can already tell you it's not going to justify today's price of $150 a share. I can already tell that just based on the growth numbers, et cetera.
Yeah, right.
So Mo, go ahead and show the chart.
So Garmin right now is for sure a power stock. And before I do this, a power stock is a stock that's over all 4 major moving averages, 25, 50, 100, and 200-day moving average, and it's making new all-time highs. So that's what Garmin's doing right now. So you can see they did a little sweet spot reversal here back in March, and they've just gone up and just gone sideways on their stochastic while the stock price has been going up. And today, they're reaching all-time highs one more time. So let's roll over to the daily chart just so I can show you that detail of the moving averages. And you can see that they're just barely over all 4 major moving averages, but this is an opportunity for you to get in and just let this thing keep going. If they every time they make a new all-time high, just keep adding to it. As long as your stochastic is still over 80% and just ripping forward. Power stocks are great stocks. They're not very common in today's market just because of the crazy volatility and fluctuations, but I think we found one. So keep an eye on it. Just make sure you're getting good volume, and let's go over the stock analyzer tool.
Okay, so guys, I made some assumptions here. Remember, you're supposed to give low, middle, and high assumptions. If you join our Patreon, which you get all this software for 80 cents a day, plus news, plus the Discord chat, everything you want for all your investment needs for 80 cents a day. It'll teach you all about the stock analyzer tool, how to input all these assumptions. I made low growth assumption of 3%, a high growth assumption of 7%. It's going to tell you the 1, 5, and 10-year numbers here. I put a lower PE in because of the lower growth rate this company has recently.
I'm curious to know what you did for shares outstanding, or for shares diluting. And are you having them dilute anymore?
1% to 0.
Okay, good.
So I hit the analyze button, guys, and the stock's currently 150. This is an overpriced stock. Yikes. I'm between 43 and 107. So there's 2 ways to use a stock analyzer tool. You can use it when you've done thorough research and said, here are my exact assumptions, and I'm very confident in these. Or you can do what I did here. Let me go look at the history. Let me make some broad assumptions and see where this falls. This is clearly an overpriced stock.
Yeah.
You can't justify it based on today's growth rates. I even show you guys what happens if I change the growth rates to the high side.
Yeah, put it up.
8, 10, and 12%. It's still overpriced. So this is telling me this is an overpriced stock, right? So do I like Garmin? Do I like what they're doing? Yeah. Do I want them to issue less shares or buy shares back? Sure. But I think for a slow growth company like this, you need to pay a nice discount. And I think I'd be buying this company at around, let me see where I'd be buying this company.
Yeah, just let them come back to reality.
7. Probably not going to like this. I'm probably buying this company under $70 a share.
Okay, so I mean, in March of 2020, it got there. It was
75 a share.
Yeah.
That's probably where I'm buying the stock going, I think intrinsic value is probably around 100 to 110 a share. So if I can buy it for under 75, an established brand that pretty much is the dominant, I guess the dominant GPS
I have to believe,
people.
Especially with maybe not the software dominant, but the hardware dominant. I don't know who else. Maybe TomTom. I don't even know if TomTom is still around. That was the other big thing. It was always Garmin and TomTom. Those are the 2 in-car things that you stick to your window.
Yeah.
Oh, I didn't know that.
Yeah.
Paul, how much margin of safety would you have if you bought it at 70%, and why is that important?
If you bought it at $70, you mean?
Yeah, $70.
You have about 35 or 40%. So guys, the goal of value investing is to buy $1 for way less than $1. If you buy a pocket of 20 or 30 stocks that are all buying at 30, 35, 40% discount to intrinsic value, you're going to be wrong on a few, but you're going to be right on a lot of them. And the goal is the less you pay for something, the less likely you are. That's what risk is the price. The more you pay for something, the more risk you have of losing capital. The less you pay for something, the less risk you have of losing capital. That's the goal with margin of safety. When you hear Warren Buffett talk about it, he says, figure out the intrinsic value. Find out what you think the company is actually worth. And your goal is to see a disconnect between the market price and the intrinsic value, where the market price is way lower. You buy at that level because over time, companies will go to their intrinsic value.
So if you started with that broad approach with the stock analyzer tool, just to make some assumptions, not doing a deep dive, and it was showing green, right now on this stock, obviously it's showing overpriced, but say it was showing green that the middle assumptions were a buy. At that point, what would you do make sure that your assumptions were good?
I'm going to do more research. I'm going to look at the news. I'm going to read the 10K. By the way, you can get the 10K from our website. You can get the news from our website. Here's the news section.
Yeah, probably hop over to Seeking Alpha.
10K, I'll go to Seeking Alpha. It's called Scuttlebutt. Just go out there and start learning more about the company. You don't have to. I'm not a big believer in, knowing everything about the company inside and out. A lot of people believe that. I do not. I believe in finding good financials, at a very low price relative to financials and making a decision once you have done a little bit of work. So the idea then is to go do a little more research and decide if you're going to pull the trigger or not in the company.
Yep.
You know, so obviously there's some people out there on YouTube that mislead folks, we believe, because they teach you that your due diligence is reading news, knowing what the company is, believing in a product, and believing in, you know, we believe in Garmin product.
We believe it. We just did a video of Peloton. We loved it. I talked about how insanely overpriced it is.
Even Tesla.
We in the past 4 videos, I think, have been Tesla, Range Rover, Tata Motors, Peloton, and Garmin, which all of them we love and use.
Yeah, we don't.
And we've
remember the difference between the company and the stock.
Yep.
There's a very big difference here. That's what we're teaching on the show. And funny thing is, Amazon, Jeff Bezos was once interviewed where he literally says, like, remember, there's a difference between the company and the stock. When he was explaining how the company went from $113 a share to $6 a share in the tech burst, and how people were asking, well, how'd you survive? He's like, well, remember, there's a difference between the company and the stock. Just because the stock plummets doesn't mean the company's plummeting.
Right.
Now, in most cases, a stock is cheap because for a good reason. But your goal is to find the 25% of the times when, wait, why is the stock cheap? Maybe it's because the market perceives it to be wrong.
Yeah, it's the emotion.
The market on Garmin is way too high. 27 times earnings, it doesn't work for me. Yeah. I just have a hard time believing that's going to be a successful investment for you. I think you got to pay about half for the company.
Right. Good point, Tim.
All right. Thanks very much, guys. Tickle the thumbs up button. Subscribe to our software, patreon.com/everythingmoney. 80 cents a day gets you all of this, gets you the community and exclusive content, because we're soon going to be making it so there's only 1 video a day on YouTube, 2 videos a day on our website and app, and the app comes out. You're watching this already. It's already been out, but it comes out literally today. Our users don't know it yet, but the app comes out today.